Drop it.
Welcome to the Be Real Podcast, the Maryland real estate podcast. I'm Michael Becker of Sierra Pacific Mortgage.
And I'm Brad Cox with the Vesta Group of Long and Foster.
We decided to put together a podcast. This is our first episode because there was so much bad information out there, Brad, don't you think? When it comes to real estate, the markets, mortgages, etc., that we wanted to put out good information for people to listen to and be able to rely upon.
Yeah, you're right, Michael. It's sometimes challenging to listen to some of the national headlines and just some people who are, I think, well-intentioned, but maybe just either don't have the right information to share or just listen to the latest trend, the latest fad, and want to glom onto that, and then they present something that's misleading to the public.
You're 100% right. I think some are well-intentioned, others aren't. They're looking out for their own interests. Some may do a podcast because they're talking their book or trying to generate revenue for themselves, whether or not it helps out the people they're doing business with.
That's true. I'm sorry. I was wearing the wrong glasses. Mine are the rose-colored
well, no,
ones.
that's,
I'll switch them
it's,
right now,
there are plenty of people out there that try their best, and, I think that they get misinformed or they come up with bad conclusions. Look, we're not always going to be right, but everything.
Well, most often, but
we're not always going to be right. But I think we're well reasoned in the things that we do or the advice that we give to people,
and well intentioned, I think.
Right,
well.
and advice is the lifeblood of our business. If you give people good advice, they tend to appreciate it, and
Trust
they will
is
come
huge.
back to you.
Yeah.
I wasn't planning on talking to this, but sitting here, having this quick discussion at the beginning of this podcast, I want to give an example of something happened. I got a call from a previous client who had a nephew who was looking to buy a house, and they always love a referral. But it turned out the nephew wasn't getting good information from their loan officer, and after speaking to her, I could understand why. This is what happened, Brad. It turns out that he found a home that he really liked. I think it was in the Nottingham area. He lives in Dundalk currently.
Okay.
$560,000 house. But there's currently they said 2.3. I said it's probably 2.375 government loan on that property. So what do you think they wanted to do?
Assume the mortgage.
Correct.
Yeah.
So, but the mortgage was around $400,000 and the sales price was $560,000.
So they have to come up with a gap.
So exactly right. So, and they weren't understanding what was being told to them, and there's not going to be a loan there for me, but I explained to them what an assumable loan is, what the process is, because I have had a client who I did a loan for who sold their house because it was assumable and the rate was much lower.
It's a very attractive
It'll make a difference moving forward.
It'll be huge, absolutely huge.
Right. So anyway, it was the point of this story is that I was giving them good information they greatly appreciated. And you never know who they may speak to, and we're glad that I gave them good information. So that's kind of the reason we're going to do this podcast.
Yeah.
We see it every day on social media, TikTok being the biggest one that sometimes gets on my nerves when it comes to the imminent housing crash, right? Housing's going to crash. It happened.
Everybody's predicting that. Yep, sure.
It happened in the great financial crisis. We saw things, property values increase greatly because of the use of improper loan products, and anybody could buy a house. Basically, if you could
fog a mirror, right?
Fog a mirror,
sure,
you could get a mortgage. But this market's a lot different than that. And
Dodd-Frank had a lot to do with that. Yeah,
that helped. That certainly helped post great financial crisis. Mm-hmm. But look, we don't have a crystal ball, do we, Brad?
No.
But
a magic 8 ball. I use a magic 8 ball. I've never been a fan of the crystal.
You and I have these discussions all the time, whether it's in networking or just between us when we have clients who ask us questions about this, because the reason we get bothered by somebody explaining there's going to be an imminent real estate crash is real estate's tough as it is now. It's a little tight now because there's limited inventory, rates are higher, houses more expensive. If you wanted to just completely scare people into telling them there's going to be a crash, nobody would ever want to buy a house. Now, certainly it happened in the past, and a lot of people were harmed by that. by the drop in values. People who bought at the height of the market.
Right.
Personally,
People who
it happened
bought
to me. I bought a house
2005, 2008. Yeah,
I
sure.
bought a house in 2005 that went up in value in 2006, then it went down greatly. I still happen to own that home as an investment property, and things worked out over time, but I don't see that happening. And maybe it makes a little bit of sense here to talk about why we don't see a housing crash. I'll start listing numbers or some ideas, and you can chime in if you want.
Sure.
First of all, if values are going to drop or be steady, they're going to drop in probably the hottest markets. And the local Maryland market wasn't super hot.
We didn't
certainly
see
saw
any
a nice appreciation.
We didn't see any of the wild fluctuations, though, that some of the other parts of the country were seeing, like Boise, Idaho, for instance, or parts of California, Texas, Florida, Arizona. They saw a very significant 40% crazy appreciation over that period, and our appreciation was much more moderate, in the teens over the past couple of years.
Why do you think those places saw such a big increase? Was it a demographic shift or something?
I think COVID had a lot to do with it, right? If you look at what COVID did, it had us re-examine a lot of things, like what's work and what is the value of home. And so people, especially if you look at something like Boise, Idaho, Boise was never considered necessary. I mean, no disrespect intended to the
Never
fine
been
folks
there.
of Boise, Idaho, right? But it was not necessarily considered the hotbed of real estate activity for years, right?
The only thing I know about Boise, Idaho was Napoleon Dynamite, right?
Right. But the point is, you had a lot of people who had California money, California real estate, who didn't have to work in their California offices anymore, who wanted an outlet that their California money could buy them. So they moved to Boise.
Well, they could escape the high taxes of California. They had a ton of equity in the house, where they could, it didn't matter what they paid to get a house there. Perhaps there were crime issues in some of the localities they lived in California, and they're probably not going to experience that. Those are the type of things. It was a migration, basically.
Absolutely.
That drove up prices in some of these higher price point areas. So now, whether or not those areas see a drop in value, I guess will depend upon if that continues.
Well, I think they're more susceptible to a more pronounced drop than what we'll see here. But still, I think it would pale in comparison to what we saw in the 2007 and down to 2010, 12.
So, locally, we probably won't see that. We're still, look, the market has changed drastically, and we're going to talk a big part in the next segment of this podcast about how we got to this point. But right now, we're looking at higher interest rates, and that's the main reason people think that values are going to drop, because affordability becomes stretched.
Well, and it is significantly reduced. If you look at the affordability index during the 3% era, it was up in 100 is considered the barometer, right? Mm-hmm. On the affordability index of the average income can afford to buy the median priced home.
A median income and a median
right. So
house.
if you looked at where it was during the 3% era, it was in the mid 100s, right? And now it's down below 100. In the last time I looked at the affordability index, and this is a national measure, but it was in the 60s, I think. And so, interest rates have had a lot to do with that, in addition to the home price appreciation.
So there's the people out there that are predicting a housing crash or anything like that, maybe off base, specifically when you talk about a local real estate market. Again, that's one thing that always bugs me. There really is no national real estate market, is there?
No, there really isn't.
It's very localized. In fact, when you think about real estate, not only is it localized, it's hyper-localized. You could have different...
From neighborhood to neighborhood.
Correct. It can be a very specific neighborhood that's doing incredibly well, and just a few blocks over may not be doing as well, or houses may sit longer on the market or may not sell for a premium. So
absolutely.
All those predictions, as far as the housing crash, we're not seeing it. There's several things that we mentioned. So, Ari, in Baltimore area, we didn't see the huge increase in value.
Right.
The loans that were done during COVID and the run-up to this increase in values were all well underwritten, full documentation for the most part.
Right.
Full
Versus
documentation.
the pre-housing crash 2002 to 7.
Believe me, I was
That
in
was
the industry, Brad, at that time, and every week we had a different subprime account manager come into the office and tell us what the latest, greatest product was. And I still remember the day somebody came into my office and said, "You'll never guess what guess what we have." And they were pitching 100% financing, stated income, didn't have to verify.
Here's
your
what I
income,
make.
with
Yes.
it, and all you needed was at least a 580 credit score. I literally said to that account executive, "Do you want people to default?" And I don't think back then, I don't think it mattered. They were selling it. Anybody who's watched The Big Short understands what went on in those days. And these days are not that. They were all well underwritten loans,
It's qualified mortgage.
qualified mortgages. They had to have certain debt ratio, had to verify income, had to verify assets. We're going to talk about it during this podcast. When people struggle to come up with those things to qualify for a mortgage, there's ideas that we can do to help them along. That'll be topics for future shows, but they're still all well underwritten loans. Beyond that, the increase in value happened over time. It went up pretty quickly for a few months, but I think it was a little faster in the pre-financial crisis housing boom. And now I think people have much more equity in their houses.
Well, yeah, but to back up for a second, the
Okay.
run-up, it was also in the pre-housing crash era. A lot of that run-up was fueled by complete speculation.
Well,
Right.
you mean back in the housing
before,
bubble?
right?
years.
Yeah, in the housing bubble,
100%.
it was all speculation. There was no equity. There was no, to your point, there's much more now, but there was no equity back then. Everybody would leverage, and you'd take that, home that you purchased, and then you'd refinance, and you'd go buy another house. And in The Big Short, they had the example of the exotic dancer who
Yes,
owned
Red
5 different homes and had no equity in it.
Well, you just made me think of something. You're absolutely right. So nowadays, if somebody comes, during that most recent increase in values, there's a lot of people going over list, right? Well, guess what? If they went over list, they also generally with that offer waive the appraisal contingency with it. So if
Right.
it didn't appraise, they were willing to make up the difference.
Make the gap. Yep.
They knew they were probably overpaying. Back in the housing bubble years, we didn't have.
There was no awareness of that.
Well, there's no appraisal independence. Many guys doing loans had their own appraisal guy say, "Hey, I need you to hit this number,"
Right.
and that's what happened. Nowadays there's
It's
so
all-
much. Not only is there independence when it comes to appraisals, we have underwriters that have much more information at their fingertips that can question an appraisal.
Yeah,
I mean, a bad appraisal is not getting through underwriting.
Right.
So there's that protection. So I guess the point I'm trying to make here that you were trying to make is that the equity seems more real now than it did back then.
Absolutely. I think that the latest metric that I read on homeownership equity in the U.S. stated that about 50% of the homeowners in the U.S. have about 50% equity now, and 37% had no mortgage whatsoever. So in that regard, with regard to home equity, it seems like we've learned a collective lesson, right?
Yeah. It definitely, it's a much more stronger, stable real estate market.
And it's harder to walk away from a home when you have that level of equity involved. So yeah, absolutely.
Correct. Which leads me to the next point, or one of the other points about a housing bubble bursting. It's tough to have a housing bubble burst when unemployment's 3.5%. Now the Fed is hiking rates and trying to slow down wage increases to get a grasp on inflation, and unemployment may rise, but I don't think we're going to see the levels we saw during the few months of COVID recession or
Right.
during the great financial crisis. Specifically in the Maryland area, I say this to you all the time in many of our meetings that we have, our networking events we go to, that Maryland does seem to have a buffer when it comes to unemployment. We have such a large federal government footprint in this area.
It's
that
much
many
more
peop-
stable workforce. Yeah.
A lot of people's incomes are related in one way or one fashion or another to the federal government. Not all, but a large percentage. So you don't tend to
but
see
it's,
the
it's not even necessarily just federal employees, but it's also all the defense contractors and any of the others associated with the industry and the whole complex.
And then lastly, or maybe not lastly, if you think of something else, one thing else, reason I think that the housing bubble isn't about to burst, and we're not going to see a huge drop in values in the local area, has to do with supply. We still have a restricted supply of houses on the market, and one of those reasons is because of where we are with the Fed's fight against inflation.
Yep.
And what I mean is people are sitting in pretty good interest rates. They may have thought of downsizing or moving up, right, at this point in their lives.
But it's hard to move away from a 3% mortgage rate.
Correct. Now, over time, that will correct, and maybe some people will sell
Sure.
their homes. I'm not sure that we need rates to get back down into 3%.
We don't. Yeah.
But if you have a 2.5% to 3.5% mortgage, it's hard to, if you're going to have to sell your home and get a new mortgage to do
Especially
that. Think you're
if you're
going
moving
to
up.
6 to 7%. Now we're probably down from 7%, but
Yeah.
anything north of 6%, that's hard to do. Now, as the Fed is successful in their fight or battle against inflation, and rates come down, at some point in the future they will. We just don't know when. That may change, but right now, the only argument I think that people that see a housing bubble or a drop in values have is the affordability issue, the expense. Values are up and interest rates are up, and that's
Sure.
the only thing. Well, the marginal buyer nowadays still can qualify for that 6% rate. Now, if if rates drop, there'll be more buyers coming in and maybe more sellers. Again, hopefully it'll become more balanced.
Well, hopefully it becomes more balanced, although it is still, I mean, if you think about inventory, you mentioned, we're in a depressed inventory situation. All right, so let's talk about what the balanced market is. The typical definition of a balanced market, where neither the seller nor the buyer has an advantage, is about 6 months of inventory, right? We haven't been at that state in the Baltimore metro area in quite a few years.
Probably
But
2019 you have to go back
been,
to.
and even I think a little bit further than that. But the point is, right now, Baltimore Metro, as of December, which is the last month that we have full month's data for, we were at 1.1 months of supply in the Baltimore Metro area
When was this?
in December, as of
Wow.
December. Yeah. So, and
It's
it's not
December, but
appreciably
December
changed.
does tend to be limited. I mean, was it?
It was, but it's still the run up
Yeah.
to that. It's been consistently at around that level.
So a
for
limited
quite a
supply is
while.
another reason we're not seeing a housing bubble or property values
There's still
dropping.
demand out there. There's
Of
still
course,
people,
we could be
people-
wrong and time will tell, but we've given 4 good reasons.
Right. And even if rates are high, there are still people who have to move, right? For whatever reason, relocation or some other reason.
Well, there's people who want to buy now. Also, there's a ton of first-time home buyers out there who would like to buy, and even though rates are higher than they would like, they
Still less expensive than 100% interest
that
rate on renting.
Rent's gone up so much too. So if you look at the cost of renting a home as opposed to buying a home, if you have some asset saves, it may make sense for you. So,
Yeah.
Anyway, the whole gist of this was to talk about why we're doing this podcast. So the thing that drove us crazy is one of the things we see on social media and the media. It's not just social media, the media kind of, because if it bleeds, it leads, right? So they're always going to have a negative headline, right?
Sure.
The imminent housing bubble will probably get a lot of clicks. Right?
Absolutely.
Not necessarily social media, but that could be media.
Well, and even if it's not the intent or the focus of their article to paint that picture, that headline's there. And what do people read?
They read the
They
headline.
read that
and don't
headline.
read
They don't
story.
read the
Oh,
content.
It
So,
drives
yeah.
me. You're so right about that.
Yeah.
So many times people look at a headline and don't necessarily even read the story, and it's not as bad if you read the whole story.
Right.
And folks, it only takes sometimes 3 to 5 minutes to read the story, and they'll just read the headline. And we don't want people to be scared. Now, look, buying a house is a huge decision, and you shouldn't be fearful. In fact, another reason we want to do this is we want to have home buyers that feel better about going through with their purchase and are happy after the fact. Here's a stat that I just thought of in this discussion that happened during the crazy COVID market of 2021, 20 and 21, 64% of first-time home buyers had some form of
Buyer
regret.
remorse. Yeah.
Yes. And then not necessarily they didn't regret buying their house, but they maybe regretted the process. Maybe they
Right.
regretted waiving their appraisal
Overpaying.
contingency or overpaying.
Or waiving inspections, which was a big challenge.
Right.
Yeah.
So we kind of want to give good information out there for people so they don't have that regret. And we also want to dispel some bad information out there that could be in social media or media. Like I said, the imminent housing bubble. Or from my standpoint, I see guys who are on social media all the time telling people what kind of house they can afford based on their income. And I'd say 99% of the time, they're recommending a purchase price that I wouldn't even consider for these people.
Well, that's one of the things that I've always appreciated about you, Michael, is when I bring a buyer to you, I have the conversation with them regardless of who they're working with, but I have the conversation with them that, just because your lender says you can afford X doesn't mean that you have to spend X.
Right.
You have to spend within your budget where you feel comfortable. And don't subject yourself to eating ramen noodles with no disrespect to the fine makers of ramen noodles, but
they're yummy.
But,
I mean, when things are tough, you have to make
tighten
decisions.
your belt.
That's what
Sure.
you're making,
right? But you don't necessarily purposefully put yourself into that situation and completely disregard a budget.
Absolutely. I say it to people all the time. I can tell you a number that you qualify for, but it's up to you to determine if that's in your budget or not.
Yeah.
I don't know what you have. I can see what's on your debt, in your credit report and your other debts, but I don't know. I don't necessarily. There's only one loan, the VA loan, that you put in child care expenses on. If you have children, I don't know what you pay for that. I don't know what you pay for health care, what percentage. I don't know if you have health issues and that you have a higher percentage, medical bills than a normal person. There's lots of things like that it doesn't make sense to push the envelope all the time, and that's always what it seems to be out there. So we're doing this podcast to kind of give out good information and help people who are considering buying a home, their biggest decision they're ever going to make in their lives, especially for the first-time home buyer. It's the biggest decision they've made to date, financially speaking.
Yeah.
So that's the reason and the purpose we're doing this show. We're going to give out great information to people, and we're going to cover a variety of topics over the coming weeks. So that's basically the reason. The next segment, we're going to talk a little bit about how we got to this crazy market, because it's nothing like, I've been doing this 20 years, and these last 6 months have been nothing like I've ever seen before.
Absolutely.
So when we come back, we're going to talk a little bit about that.
Great.
Drop it.
Hi, and welcome back to the Be Real podcast, the Maryland Real Estate Podcast. I'm Michael Becker of Sierra Pacific Mortgage.
And I'm Brad Cox from the Vesta Group of Long and Foster.
Hey, Brad. Right before the break, we were talking a little bit about, or we mentioned that we were going to discuss how we got here.
Yeah.
Obviously, the last 6 months.
The long and winding road.
Yeah.
Or maybe it wasn't so long, actually.
Why you got to bring up our high school reunion song? That was like wasn't that our
That was our high school theme song. Yes.
For the graduating year for us. But anyway, we wanted to talk about how we got here. It's in a market like we haven't seen in my career, which is a little over 20 years in the mortgage world and in the real estate world. So some crazy things kind of happened. So it kind of makes sense to do a little rewind, talk about how we got to what happened and how we got to where we are.
Yeah.
So it's obvious. It's one word that changed the world as we know it forever.
Should we say it together?
Yeah.
COVID.
COVID-19. COVID changed everything. I remember back in the days, I remember when we were talking about the shutdown coming, and then the term that everybody talks about, 2 weeks to flatten the curve, that turned out to 2.5 years of some very different conditions. So COVID did change everything. In 2019, at the end of 2019, the beginning of 2020,
The last normal market.
we had a pretty normal market.
It was.
Rates were
Very
higher than
healthy.
they had been in previous years, but real estate was doing very well.
It was.
Now, rates did drop through most of 2019.
It started at about 5%.
They started at the year around 5%. Into 2018, into 2019, right around 5%, and dropped throughout the year.
Yeah.
But real estate was pretty strong. People were buying and selling homes. The rates weren't restrictive. I don't. People.
Well, historically, 5%.
People
If you
weren't afraid.
Compare that to the 80s.
Yeah.
It.
Well, that's something you would always say when rates
Right,
come.
right.
It's something that loan guys always pull out. You know,
Right,
they always
sure.
pull out the 80s, right?
Yes.
Like, my parents paid 18% on the first house they purchased. Yeah, and they forget to mention it was $55,000 house.
That's right. That's right.
But anyway, you're right. 5% is still historically a pretty good rate. There's been a few things that have happened in the last decade or two that have driven rates down. They may happen in the future, they may not. But in 2019, we had a pretty good real estate market, and the economy was doing well. And then we started hearing rumors about this disease. In fact, I saw it firsthand. I was in California in January 2019 for our annual conference. And when I was leaving the airport in Sacramento, something I witnessed at that airport that I'd never seen before in my life was a high percentage of people wearing masks. And then as I got home, the story started breaking, about this disease that came from the Wuhan market it was coronavirus, like SARS, but they called it COVID-19 because I guess it was discovered at the end of 2019. But it started becoming a big deal in 2020.
Right.
We had shelter in place, all these rules, and when it first hit, it hit real estate really, really hard.
It did.
Do you remember?
Well,
did you have any? I can think of a specific deal. Like I remember, I had a deal closing a couple days after the shelter-in-place order happened.
Well, and it almost probably didn't happen, because if you look at what happened in, say, our neighbors to the north, Pennsylvania, their entire real estate market was shut down for months. We were lucky, actually. We got declared essential pretty early on in the, after the outbreak really started taking hold. And we figured out a way to work through the process and keep people safe. But we almost didn't have that.
So they literally, in Pennsylvania, they literally shut down. Like there were no closings going on for a few weeks.
Nothing. For months.
For months.
Yeah.
Oh, that's pretty drastic. Well, that's what happened. That's, when I'm going back and trying to figure out where we are, how we got to where we are now, when COVID first struck, my point I'm trying to make is that it really crushed housing. Even though there was some stuff getting done, people were afraid of listing their house. Think about it. You were worried about the disease. Did you want anybody coming into your house?
You couldn't have anybody coming in.
Nobody wanted. You didn't
Sure.
you couldn't for a while, right?
Right.
And then think about the home builders at that point. Nobody's going to come. You can't even go look at a house.
Right. Sure.
Heaven forbid. So they probably pulled back as fast as they could on home construction. So, and housing is always such a big part of the economy. It really crushed housing initially.
Yeah.
So the Fed met on March 15th, 2020, had an emergency. I don't think it was a normal meeting. They do tend to meet in March, but I think this was an emergency meeting because when I went back and looked at the Fed meetings of 2020, there seemed to be a gap there. Well, it makes sense, a gap in their meetings, because nobody was meeting in person.
Right.
Everything was shut down. They had an emergency meeting, and even though they had been cutting interest rates a little bit to stimulate the economy, because at the end of 2018 things slowed down a little bit, and they cut a little bit. I think they cut rates, 4/4 point rate cuts for the entire year of 2019. They met and decided to cut rates to zero, which they did back. It's the same thing they did back in the housing, when the housing bubble crash or the great financial crisis happened. They cut rates to zero. These are short-term rates, right? So the Fed cutting interest rates like that, they tend to affect short-term rates or overnight rates between banks, which leads to the prime rate, which is more effective on credit cards and things like home equity lines of credit, but it doesn't necessarily impact long-term rates like mortgages. So also during that time, they announced that meeting that they would start doing a thing called quantitative easing. Right. Quantitative easing is when they expand the money supply by purchasing U.S. Treasuries and mortgage-backed securities, bonds that are backing mortgages. They did that. They announced that they would do that to the tune of $500 billion for U.S. Treasury bonds and $200 billion for mortgage-backed securities. Now, that wasn't even enough to get things rolling.
Right.
So they came out and said it would be unlimited. Quite unlimited amount, to a tune of about $100 billion a year. We saw the Fed's balance sheet, which is the debt that they own, that they have bought through their quantitative easing programs, balloon from about $4.5 trillion to about $9 trillion. Now that had a big effect on interest rates and the real estate market. It took a while to hold and the volatility to go away. Because I remember March, April, and May, people would call me all the time wanting to refinance, thinking because they would look at a 10-year Treasury because that's what people look at.
Right.
Get an idea what's
Typically,
going on
right?
with
Yeah.
rates. Right.
Lockstep almost. Yeah.
Right. It's a pretty good correlation. Yes.
Yeah.
But mortgage rates weren't following suit. But after, I'd say about May, they started dropping and they got pretty aggressive. We still had COVID restrictions. I feel like we were locked down for a couple months. March, April, and the beginning of May, most people didn't do anything.
Yeah. We were still showing homes somewhat during there, but the volume was down significantly.
Right. But then, as we got there were still people worrying about COVID, but then the Fed did everything to lower interest rates to stimulate the economy. And then the federal government jumped in and created what's called the CARES Act, was the first stimulus bill. And then Biden, when he became president, did the Build Back Better stimulus bill. Both of these, they spent like $6 trillion to stimulate the economy.
A lot of money in the economy.
So there's all that money sloshing around, driving interest rates down, and COVID changed the way people think about work, right?
Absolutely, yeah. Didn't necessarily have to live next to where you work,
Right.
which is again the example that we talked about with Boise, Idaho in the first segment. The California money that didn't need to live in California anymore and escaped and moved out to, I shouldn't say escaped, that was a slight to California.
No, you could say
but
escape.
Yeah, but you're escaping some of the higher taxes, let's say that, and moving to Boise, where you could get a much more affordable home for your money, and they didn't care as much about how much they spent on that.
Correct. So we had the interest rates. It was ridiculous how low they've got. I've never seen interest rates, and I don't know if we will again, on 30-year fixes in the twos before. And that's something, they had gotten in the low threes before in 2012 and 2016
Right.
when the Fed was stimulating the economy. But drop into the twos, and values hadn't started rising at the beginning of COVID yet.
Right.
But people became more and more interested in buying either.
Well, the money was free money.
It was free money. It was cheap money. You didn't have to live near your work, so it gave you you could actually buy somewhere that you wanted to live, not necessarily in a city or near an urban area.
Really made people re-examine what home meant for them.
Yeah, it certainly did. So that kind of drove that market. That, people started buying houses, and then I guess that was the start. When do you think, Brad? Because I think about this all the time. Because 2020 was a year of very low interest rates, and the Fed was fully motivated to keep rates low, and the federal government with their stimulus program started getting things going. But I don't think 2020 was the year of huge increases. I think they started in 2020.
You're right. Yeah, it was a little bit of an increase in 2020, but 2021 was, and 2022, even the very beginning of 2022, we're still seeing significant increases.
Right. So I bought a second home in 2020.
Mm-hmm.
Had such a great year in 2020. Mindy had always wanted a beach house. I decided to take a look at one, and I remember that's probably about when it changed. So now we didn't see an increase in values, but what started happening at the end of 2020 led to the increase in values. And I'll give you an example. We went to see a house or a beach condo townhome that we thought we might like. We saw it online. We viewed it, and this is what happened. We had to submit our offer by 11:30 because all offers we saw it at 10 o'clock in the morning.
All offers have to be in that day.
By that
Right.
day. And we had to determine what our offer was going to be to beat it, and we had to go over list. We had to buy it as is with the right of we at least had the right to inspect the home and could cancel if we didn't like what happened with the home inspection. Had to waive any appraisal and contingency, meaning if it went over and it didn't appraise, I was
You
going
had to
to
cover
make
the
up
gap.
the difference.
Yep.
And those were things that I'd never heard of before, but I kind of felt good about it because what I offered, there was a house very close by that there's only one comp, and one comp doesn't make an appraisal, but I thought maybe it'd appraise. It didn't appraise. I had to come up with more money. In the end, it's worked out for me because the continued appreciation has helped that house go up a good bit in value. But I think that might have been the start of things, that values going up. And it really changed the world because people had to figure out a way to buy their house. There's so many different things that I'm thinking of right now, implications of this. First of all, there was a change in technology at the beginning of the process, something we never heard of before. If you put in a large down payments, you could get appraisal waivers.
Right.
From the underwriting standpoint, everything could be digitally. I used to always meet with people face to face to take a mortgage application, especially on a purchase, because you want to kind of get to know them. Well, that's certainly changed. You couldn't meet people face to face. If they wanted to do a Zoom, you could do that, but all of the times it was done electronically. I would email them my app. They would download that app, fill out a loan application. I could pull credits. I could often verify their employment, income, and assets digitally. Basically, the loan was done except for an appraisal and title work at that point. So that kind of helped speed up things. But if you're doing faster transactions, guess what? It speeds up everything. Houses are selling faster, limiting the supply, and that added to the increase.
Absolutely. Yeah, the supply dropped precipitously.
It did start to drop.
Well, the thing is, to your point, homes were selling off much more quickly, but then also, fewer people were willing to bring their homes to market.
Yes. So you have houses selling quick, coming off the market. You're right. So what's the tip? So
it's the
low interest rates
of both of those factors, right, that just drove that inventory down.
Right. What is a typical time on market in a balanced?
In a normal market, 30, 45 days,
right,
somewhere in there. Yeah.
Now
it was a day or two, maybe.
Yeah. Sometimes they wouldn't even make it to, they'd have a coming soon thing, and somehow somebody would talk to the agent and get the house off the market before it even got to market.
Yeah.
It was crazy. So, yes, and not only that,
there were people writing sight unseen offers. That's how crazy it got. Sight unseen, never walked into the house, because by rules, the MLS rules, you're not supposed to show the property during coming soon status. So people were writing sight unseen offers.
Not even a video tour or a Zoom tour?
Just off of the pictures. Yep, that's the house we want. We're going to fight for it, because you couldn't get anything else.
No. How about this? So people were doing that. Think about how it affected two types of borrowers or clients I'm thinking of. One is the first-time home buyer.
Decimated them.
It's brutal for them. And second, how about people who had to sell a house? Let's talk a little bit about each of those situations. Like, let's say, all right, so let's door. So COVID came along, federal government, the Federal Reserve acted, stimulated the economy as fast as they could. Demographic changes because people could work from home and not have to live near where they work. They could live anywhere they wanted. Really stimulated the economy. So people who wanted to make a move, who wanted to buy a house but had an existing home, but had a lot of their wealth or money that they would put in this transaction wrapped up into the house.
Right.
What troubles did they have?
Well, it was a challenge, right?
Nobody wanted to take a contingency.
Nobody would take a contingency.
What's a contingency?
Well, that's when you prepare the contract and you say it's contingent on the sale of the buyer's home.
Almost always happened that way in the past.
Oh, yeah. It's almost a given, right? In a normal market, somebody's living somewhere currently, and unless they're renting, they have a house that has to be sold. And so there was almost always a contingency.
So how did people deal with it at that time? I can think of how some people dealt with it. There's two ways if you have a house and you want to buy a new home and you have a lot of equity in it, especially if it's a competitive situation, and you may want to go over list, or you want to waive some of these other appraisal contingencies. You're going to cover an appraisal shortage, or you're going to waive your home inspection. You have the right to inspect it, but you're not going to cancel based on unless something major is wrong. People had to do a couple crazy things. Sometimes they had to, did you ever have they list and sell their house before they bought the new one, or be under contract to sell that existing house?
Right.
So they didn't have to have that home sale.
And then negotiate a rent back, because sellers had all of the leverage. So they could say, we'll sell it, but then when we sell it, we're going to tell the buyers, but we need an extra 30 to 60 days in this home to find our home of choice.
House in a given.
Right.
So there was that, and then on top, let's say the house that you wanted, the seller wouldn't even consider that, so that's out.
Right.
So there were occasions where people had to figure out a way to come up with the funds to down payment, go over list, do all these things without selling their house. And it became very difficult from an underwriting standpoint, because if you're going to do that and your house isn't sold, you have to carry both houses in your debt to income ratio.
Right.
And then there's the other aspect of coming up with the down payment and the money. So for the asset side of it, people did some very risky things. They would take money out of a retirement account, use it as their down payment, closing costs, and maybe go over in
Or
hopes.
even liquidated enough to pay cash for
Yeah.
the next property, to write a cash offer,
Oh yeah, even that, right?
and then hopefully replenish after the sale of their home.
Yeah, they would. So by if you pull money out of a retirement account, you have 60 days to put it back in. It's considered a rollover, and some people would do that. But the second you pull that out, the clock's ticking. You have to close on this. You generally probably do that right before purchase, and then hopefully you could sell your house fast. Now houses were moving so quickly, that was the case. But there's things that could happen during the approval process for the person you're selling to that can make that a bit nerve-wracking. So
Sure.
those were crazy times. And then from the approval process, there's not a lot of people out there that can handle carrying
Two
both
mortgages at once. Right.
So if you are buying a new home without selling your existing home, you must carry the two. Now you can take the existing house out of your debt ratio during the purchase of a new house if it's under contract and all financing contingencies have been cleared on that purchase for the
Right.
person buying that house. And that would happen sometimes, we would do it that way. But we're just bringing this up to highlight how difficult it was if you owned a home, right? And you've been through this game before. Now let's get to the next people, the first-time home buyers trying to buy a home.
Just couldn't compete. How do you come up with?
Housing values were going up. So median house probably went up from the mid 200,000s
Up to 340, 350, 360.
right. I was going to say to the mid three, up 100.
Yeah, mid
grand.
threes. Yep.
So that increases the minimum down payment that you need, and you're going to have to cover closing costs. So saving for one thing we should say that is, I still am amazed today that people still think that you need 20% down. You don't to buy a primary residence. There's 0, 3, 3.5% downs. Those are topics for other podcasts. But with the values going up, people having to save for that. I mean, let me ask you this: did you have first-time home buyers during COVID that wrote more than 10 offers?
Yes.
Exactly. I knew that.
We had one rather unfortunate but persistent buyer, God love them, who they wrote about 15 offers before their offer was accepted. And it's simply because, the first-time home buyer, typically, home ownership is one of the ways that you can build wealth, right?
Mm-hmm.
And so the existing homeowner has typically a much higher net worth than an average renter.
Right.
So if you have a first-time home buyer who doesn't have that wealth accumulation over the years, and they're trying to come up with money for down payment and closing costs, and then you have to come up with money to spend over list and guarantee the gap if you're bidding over the purchase price, well, it's a really tough situation for a first-time home buyer.
It was incredible. I asked you that question because I had people who and thank goodness they must have had great landlords, because I'm trying to think back at the situation where they were renting and how they were going to buy a new home and then get it. They had short-term extensions on their lease and they ended up paying more in rent.
Month to month, higher rent. Yeah.
To handle that, and it was so very hard. Not only were we dealing with limited inventory, a ton of competition from other first-time home buyers and potentially people who might have deeper pockets than you. First-time home buyers had to deal with people or companies, I should say, who had extremely deep pockets.
Yes.
Blackstone spent $50 billion.
Institutional
in real estate.
investors, yes, absolutely.
28. No, excuse me. I'm going to give you a stat here. I said 28. I believe it's either 28 or 24. Let me look it up, Brad, so I'm correct. Okay, it was 28%. In the fourth quarter is it fourth quarter? First quarter of 2022, which kind of, even though rates were going up, 28% of homes were investment properties, and a lot of them were institutional buyers, and then other people
all
who
cash
or flippers, people who could see the values go. Anytime values are going up pretty quicker, you're going to see people enter the market who are going to try and buy houses, the unimproved houses, fix them up and sell them turnkey to the first-time home buyer who wants to do that,
right?
Who wants to buy it that way,
right?
So, it was brutally hard to get an offer.
Well, and they're all cash offers, and so any kind of financing that you had paled in comparison to the cash offer. You don't have the uncertainty of an appraisal or any of those other issues.
So COVID turned the real estate market and the mortgage market on its head. We had all-time low rates. They were low for a long time. The Federal Reserve kept interest rates low and kept their quantitative easing bond buying program going well into 2021. In fact, the entirety of 2021 and into 2022, they were doing it. Inflation started rearing its ugly head at the end of 2021, and the Fed said the famous one-word term, it was transitory.
Right.
Remember back then, see, that was a big thing that they said. When everybody was pointing out that inflation was coming, that the Fed should be cutting rates, they thought it was transitory. They thought it was supply constraints that were going to come back quickly and inflation would go away. In fact, if you want to talk about Fed predictions or predictions for interest rates, the Fed saw no interest rate cuts or raises. I'm sorry, not cuts. Any raises in interest rates, the short-term rate that they raise, until 2024. They had no expectation through 21 and the beginning of 2022.
Well, and we all know that changed.
They were wrong about that.
Yes.
So I guess I'm trying to do a timeline. We had a crazy, crazy market and all this free money going out there, and the real estate market was going crazy. Real estate was going up. Guess what else went up? Rent. Rent's a big component of inflation. It's I think it's 24 or 30%, somewhere in that range in the consumer price index. So that was part of what was making inflation go up. Then you have supply constraints, and all this money sloshing around the system kind of made interest rates go up. So while rates were low and demographic changes because of COVID made people want to buy houses, then we roll into 2022 and the Fed is forced to switch gears pretty quickly.
And it's a dramatic change.
We saw interest rates go up. I mean, it happened almost overnight. I mean, rates stayed low to the last day of 2021. Soon as 2022 began, January 3rd, the first trading day, we saw bonds selling off, and it almost continued unstopped through the first 5 months of the year. It was not an easy time to be a loan guy because rates were going up so fast. Somebody you thought would qualify may not qualify because by the time they find a house because the
rates had changed so much,
gone up so much.
It was the most precipitous increase in rates in recorded history.
Well, they went up. As a percentage, you're probably right. If you just look at nominal terms, meaning going from say 3% to 7%, 4% doesn't sound a lot.
That period.
Right.
Yeah.
It was pretty fast. Inflation reared its ugly. It got as high as 9%. I think it was 9.1%. We did see a nice little rally in 2020. From May to like July, rates came back. Maybe the market thought it was getting ahead of itself, but then inflation kept creeping higher and higher, and the Fed came out and had to be more hawkish, which means they're determined in driving down inflation, and people had to start reassessing how many interest rate hikes they're going to do. And it was not only interest rate hikes that they were doing that affected the long-term market, it was the opposite of quantitative easing. Once they stopped buying mortgage-backed securities and treasury bonds, the quantitative easing to drive down long-term rates, they stopped that first. Then they just let bonds roll off their market. It's called quantitative tightening. So they're reducing their balance sheet. So that adds another layer to it. And we saw rates go up so fast that we were looking at a 7% rate. When this all started, and I saw inflation going up and the Fed was going to be active, I think I had the conversation with you. I thought that we'd probably see a top of rates between 5.25% and 5.5% on the 30-year fix.
And early on, we thought that.
Yeah, because in 2019 and in 2018, real estate did slow down a little bit. As soon as rates hit 5%, it seemed to be a threshold of people.
A little pause, yeah.
And same thing kind of happened then. And then then the rates rally a little bit, and people are like, okay, it's not so bad, or they come to accept it. But that pause was very short-lived. By July, the rates started rising again, and I want to say, was it probably October was probably the height this year
I think
of 2022?
that makes sense.
We're looking, we had, even Freddie Mac's survey came out with over 7%. There were
Right.
people, depending on their situation, that were looking at 7% interest rates on 30
or
30-year
higher,
fix.
depending on credit score.
Yeah,
But
if,
yeah,
you, if
sure.
you're credit challenged, you might be looking at a higher rate. So,
Right.
But as we mentioned in the first segment, we're not seeing values, especially in this area, drop. So that becomes a challenge to
With
get people
affordability.
qualified.
Yeah.
Affordability
Sure.
wise. So 7% rates were not good. Now, the good news, folks, is that the Fed has stuck by their guns and said they're going to, they're not going to. The market keeps expecting them to pivot. The Fed is saying, look, we're not going to. The fight, 3 or 4 months of reduced inflation we're not over. It's not done yet. It could come back, especially because they have the example of the early 80s. Remember when the Fed pivoted back then? There was a big fight against inflation. Arthur Burns was the head of the Fed at that point. He pulled back rates, and then he had a second round of inflation.
Right.
Paul Volcker had to step in and be pretty aggressive and see rates. So where we are now is in a pretty difficult real estate market. Now, it's not impossible, but it's a little tougher.
It's a little bit more of a challenge.
Yeah, it's tougher to get people qualified. It's tougher to get people excited about buying houses, but it's not impossible.
Well, and as we said before, there's still people who need to move for whatever reason, right? You have people who are relocating, and companies are changing the work from home requirements still. We don't know if that's going to persist, actually. Right? There's some of the.
I think work's changed forever, but you're right. I think employers do want people back in the office, at least on a part-time basis. I think what's going to happen is a hybrid model, for most people, right?
Yeah.
Work at home a few days a week and be in the office a few days a week.
Makes sense.
I think we had some productivity losses during COVID because people were working at home.
Right, but it's going to be hard to peel back that. Once that freedom existed,
Right.
taking that away from people will be a real challenge.
So we've, like I said, rates got to 7. They've come back. So the reason for the show is to look forward and talk about what's going to happen in the future and what's happening right now. So rates have come off their height. I feel pretty confident that the high in rates has probably been in. Now, something could happen that I don't see right now, like some kind of war.
Well, that's the degree of uncertainty that I think is keeping the rates slightly higher than they really historically should be.
That's a good point because people don't know what's going to happen, and anything that affects the supply chain. I mean, the federal government, unfortunately, is still spending
The whole issue with
money.
Ukraine. Ukraine is a natural resource.
Correct. Between banning Russian fossil fuels
Right.
and Ukraine being a breadbasket for Europe, we've seen that's definitely contributing to inflation. China had some COVID issues and lockdown issues with that have also disrupted a little bit of the supply chains that persist. It's not been as easy as people thought to bring all these supply chains. Heck, the auto industry is still dealing with microchip shortages and not being able to, they used to sell, I'd say in a good year, 17, 18, 19 million cars a year. They're selling about 14. I think the best year was 20 million cars. So
Yeah. But that's the point, right? This degree of uncertainty, I think, is keeping those rates slightly higher. If you look at the gap, typically, between the 10-year Treasury and where the interest rates are, historically, and say over the past 10 years, that's averaged around 1.7%, right? At the highest point, we got up to the gap between 10-year and the interest rate is over 3%, and now it's about 2.5%.
It's a pretty big gap, yeah.
So it's still much
So
bigger
I guess your
than-
point is that your rates could come, if nothing changed now, right? As far as the market and long-term rates are considered, the benchmark rate of the 10-year Treasury, if it didn't change and some uncertainty got removed from the market, we could still see an improvement in
we could
30-year
still
fixed
see something.
mortgage.
Yeah, I think we could see rates closer to the 5.5% mark Not the threes, obviously, that we had before, but back to a more standard gap between the 10-year and rates.
I think that's probably what's more than likely going to happen. We'll see. Inflation has drastically improved. Hopefully it'll continue. We did have the latest CPI, or Consumer Price Index, which I find interesting. That has become the most heavily traded economic report, even though the Fed has a different inflation number that they say they look at, but it's the consumer
the markets take.
Yeah. It's the Consumer Price Index that they look at. If you look at the headline number, in fact, last month's headline number was a negative. Prices went down mostly because of energy and because of gas. So we'll see. But moving forward, hopefully the high in rates is out, is behind us. We're not going to see a drastic drop. Anybody who's calling for a Fed to pivot because they're going to slow the economy down so much, even if the economy slows drastically, they're going to be slow to respond and cut rates until it's obvious to them that they have to.
That they've got inflation under control.
Well, they got inflation under control,
and that they're killing the market.
Killing the economy.
Right.
Like I said, they look at employment, and the jobs report recently, the overall headline employment number dropped. The number of jobs created was a little higher than expected, but the quality of those jobs seems to be declining. There was a huge increase in part-time work and a slight decrease in full-time work, and that was reflected in average hourly earnings. So they are getting some headway, even though the headlines don't show that, in the fight against wage inflation. So looking forward, we're hopeful, and we're going to give information out there to buyers that it's not going to be as difficult for move up, move down buyers, and most specifically, first-time home buyers.
Right.
So
we are starting to see inventory beginning to creep up, right? I mean, it's
are there specific price points where that inventory is creeping up, or is it across the board?
Well, there's still that entry-level home dearth of inventory that's going to be a tough nut to crack, because builders just aren't building.
Well, we haven't been building for years.
Well, but even when they do build, they're not building that kind of home.
That's a topic for another podcast.
Yes,
Why?
it is.
Are there
Right.
not enough entry-level homes being built? Yes. Well, there's lots to talk about for our listeners. But I think it was important to do this podcast and talk about that. It's been a crazy few years. There's a lot of misinformation out there. And we're going to guide you through it. I think I think 2023 is going to be a better year than 2022. It might start off a little slow, but I think we'll see improvement for anybody out there who's looking to buy in the coming months. Like you said, as rates come down, maybe people who have been frozen in their homes because of an ultra low interest rate, A, might get a little antsy and want to move, right? B, the differential between the rate they have and the rate they can get on the next home will
Shrinks
probably
a little
come down
bit,
a little
right.
bit. And see, people just will decide that they got to do it, as long as, and we still have a ton of millennials who don't own homes.
The delay of their home purchase has been one of the things that's been talked about in the news pretty significantly. But we are starting to see that generation become the largest force in the home buying market.
Well, I think I think 2023 will be the spring buying season will be mostly about first-time home buyers, and that's probably what we'll talk a lot about in the coming podcasts, about how we're going to help those people become it. But guess what they're not going to have to deal with, probably? They're not going to have to deal with 17 offers. They're not going to have to see a house at 2 o'clock and make a decision by 2:30 whether or not they're putting an offer and their best offer. They're not going to have to go over list price. I mean,
right.
Lots of those
things. There's still a degree of that lingering in the market right now, but it's nowhere near what it was before. And instead of seeing 30 offers on a property within a day, now maybe we're seeing 2 or 3, and so it is definitely improved significantly.
That's improved, and
sellers are they're waking up to that reality. It's a slow awakening, but they're starting to
You're right,
realize
because I think there's I don't see it as some homes around here, but I think Realtor.com had a study about the number of percentage of homes that actually drop the list price. Now, those list price probably had to drop because you had agents.
Because it was aspirational. It was
putting
an
out
aspirational
ridiculous
price.
numbers. Yeah. I mean, you probably deal with that sometimes when you're going up against, you have somebody else competition for a listing. And,
Well, there's, yeah.
like an listing is another listing agent might have you have the client's best interest at heart, and they may be telling them to list it for this number.
Right. Which is why I think we're starting to see more expired listings on the market now.
Oh, because the person can't sell
because
it.
Because they can't meet what they promised. They can't deliver.
When a listing drops in value, a lot of times there's a psychology with that people think, well, what's wrong with the house?
Right. It must be something wrong with the house. But
they're not getting
it's
any
not
numbers.
necessarily anything wrong with the house. It may have just been the wrong price.
Another encouraging sign for people, first-time home buyers or people buying homes, are what happens after being under contract. Sometimes a home inspection comes up and shows a problem or an issue that's going to cost money for the buyer to fix. In the past, tough luck, pal. I'm not giving you anything.
So the sellers had, again, they had all the leverage, and now sellers are, and I don't have the statistic in front of me. Maybe I'll grab that for the next episode. But the percentage of homes that are getting seller help now, and that's typically in this market, it's still not up front as much, but it's typically a renegotiation after inspection.
Yeah, it's an addendum after the fact.
Right.
You may not have had seller help, but let's say, look, they're going to have to fix this, and they're this far along in the process. The sellers, they're happy. They're sitting on a ton of equity. That's a point to be made. So one of the best things looking forward is sellers who have a ton of equity in their house may be a little bit more generous about helping the buyers out, whether it is closing costs help or post-contract, an issue coming up that's going to need some fixing, giving seller concession to help cover that cost.
Right.
So that's an encouraging thing for people. I mean, back when it is a balanced market, a lot of times first-time home buyers, we say, it's always a challenge to come up with closing costs and down payment, and then heaven forbid they had to come up with going over a list. Well, that's gone away. If seller concessions come back, maybe we can help people get into homes for a little less money out of pocket. And the worst thing we want to ever see anybody do when they're buying a home is to empty their bank account. We always like people having the rainy day fund, or 3 to 6 months of assets, or maybe even some more money than that, because when they buy a house, they're going to want to either buy a few things for it, or
furnish it, perhaps.
Or furnish it, right?
Right.
Do you remember back in the days, the housing bubble days, when they were building the McMansions, they used to call it, and anybody could buy it? I remember driving around at night this time of year, because it gets dark early, and you could look into these houses
that were completely empty.
Yeah. These gigantic 5,000 square foot houses that somebody bought, and they can't even, maybe they can buy one recliner. That was about it, and a TV in the corner or something like that.
Right.
Anyway, it's been an interesting real estate market. The point being, folks, that things are getting better, and we're going to talk about that in future podcasts. So we encourage you to continue tuning in to this podcast, and we'll pick this up on next week, and next time we do this. This has been the Be Real podcast. I'm Michael Becker, and you are?
I'm Brad Cox with the Vesta Group of Long & Foster.
And this is, what's the subtitle for the Be Real podcast, Brad?
The Maryland Real Estate Podcast.
Take care, folks. We'll talk to you real soon.
Take care.
Try me.